This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day. This is Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go on our Knowledge Center, which gives you a direct link to YouTube, where we've had well over 1 million views, multiple videos that help answer the questions that you have. And if you want to put an inquiry so we can talk about it on the show or create a Knowledge Center video, please send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And also you can go get this episode, any one of our previous episodes on Spotify, podcasts, you name it, folks. Now, I'm the president of Falcon Wealth Planning. We are a fee-only, non-commission, true fiduciary, folks. And we talk about all important topics of personal finance. That's where you are today, how retirement looks like, investments, estate planning, insurance, folks, you name it. Anything that involves a dollar sign, we can help you with. And we are offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. And we have offices all across the country that we can help you with. Folks, give us a buzz. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, where we can help answer those questions that you have to help with your financial situation. I wanted to take some time today to talk about the fires that are going on here in Southern California. And I know living here and just seeing what everybody's going through, almost everybody has known at least one person that has been affected by the fires. Almost everybody knows somebody that has been evacuated, but literally knowing somebody that lost everything. It's kind of crazy to think that it's happening here in 2025. And without going into the politics, which I promise you, I'm going to have an episode that I'm going to focus a lot of time just talking about the economics of what's going on here, of why this happened. Like truly, you're hearing a lot of propaganda, whether it's from X, whether it's from Gavin Newsom in the office over Karen Bass. You're hearing a lot of stuff out there. I'm spending the time specifically till I get to the bottom of all of this. But right now, the goal and the focus is to make sure, number one, no lives are lost. Number two, the least impact on people for their personal lives. And then, of course, the financial impacts that are out there. So our hearts and prayer are for here in Southern California and for everybody around the world going for duress. Here we are, folks. We are in 2025. We are in the root of it, and we are looking to look at some of the changes for this year that are going on. Now, here's the thing. There are always something going on, right? Always something in the new year. There's some changes that happen. It could be how much you save into your 401k, your Roth account, how much of your payment of your salary goes towards Social Security. Every year, these numbers change for the most part. So I thought, hey, why not spend still the early part of 2025 to talk about what these changes are? So I wanted to spend some time going over this. And then I want to talk about after 2025, starting in 2026. So I can officially say, less than a year from now, what tax laws are changing. I think that's extremely important, folks. So let's start off. Right now, for people who want to contribute to an IRA, it is $7,000. If you're over the age of 50, it is $8,000. Now, the income limitations, if you're married, $126,000. If you're single, it's about $80,000. You can make a little more than that, but then it phases out. Roth IRA, same thing, not just traditional. $7,000 if you're under 50, $8,000 if you're over 50. Now, here's the thing. Your income limitations start, if you're married, $236,000 and $150,000 if you are married. Keep in mind, this is your adjusted gross income. Now, here's the thing. SEP IRAs, you could do a whopping $70,000 or 25% of compensation. And now, Also, simple IRAs, $16,500. If you're over 50, you can put an extra $3,500 in, which is $20,000. 401ks, $23,500 for 2025 and $31,000 if you're over the age of 50. Defined benefit plans for those self-employed people that save a bunch. You can put $280,000 a year in those. Now, annual gifting is $19,000. If you're married, you and your spouse can give $38,000. That's the same amount you can annually contribute for a 529 for your child or grandkid. Now, you are allowed to do a 5-year accelerated amount at $95,000 if you're single, $190,000 if you are married. Coverdale education, not much changes there, $2,000 for beneficiaries under the age of 18. If they're single, the phase outs is $95,000 and $190,000. Now, income levels have always changed. They always seem to be changing. That is almost $24,000 now in the lowest tax bracket, and almost $100,000, $96,950. Let's just call it 97. $97,000 for married filing joint taxable income. Cool part with that is that allows you to get capital gains tax-free, long-term that is, and qualified dividends as well tax-free. Pretty sweet. Let's continue the conversations. They increased the estate tax a little bit to $15,650. Anything over that in income in estates or trusts is a 37% tax. Long-term capital gains, like I said, not much changes here, folks. The 0% tax bracket here on long-term capital gains, get this, it is still in that 12 to, which will be 15% bracket, which is almost $100,000 if you're married and almost $50,000 if you're single. Now, the 20% rate, if you're married, it's over $600,000. If you're single, it's $533,000. So yes, those are continuing to creep. Now, annual gifting amount, this is also for estate tax reasons, okay? Any amount over almost $14 million. I don't know why they did $13.99 million. I'm just going to call it $14 million. Anything over that you give somebody, you have to pay tax of roughly 37%, and potentially states like Washington and Oregon and a few others that may tax you as well. But the idea and logic here, of course, is that's the lifetime you're allowed to give. You can still give $19,000 a year without filing a report, which is a 709 form, but the $14 million, if you die with anything over $14 million, or let's just say you have $24 million and you're only allowed 14, assuming you're single, that $10 million is going to be taxed at that 37% rate. So yes, these are very important. The last year now of the standard deduction that we look at it today, which I'll talk about a little bit later, this part is interesting. It's exactly $30,000 for a married filing joint, which is half for a single, $15,000. So just interesting things, right? Just always updates on income and things like that. So just important to know, I think. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth here. And every weekend, we're talking about all important topics of personal finance. And I thought, hey, let's just talk about some of the changes here in 2025 on income and how much you can contribute and so on. So let's go over and talk just briefly about Social Security and Medicare. And so right now, nothing's really changed, right? If you're born after 1960, your full retirement age is 67 years old. Keep in mind, if you delay your Social Security and you're born after 1943, you still will get that 8% raise every single year that you wait. From 62 to 63, from 67 to 68, all the way until 70 years old, you get an 8% increase. Now, here's the thing. Our salaries, back in the day, man, I feel like it's 10, 15 years from now, it used to be like $113,000. After that, everybody's paycheck got a little bigger. Why? Because the federal government, your payroll company, withholds about, we'll call it 6.5%, 7% of your paycheck, and your employer pays 6.5%, 7% of your paycheck. Why? To pay towards your Social Security benefit that you will eventually receive. It used to be $113,000, then it went to $118,000, then it went to like $130-something. Next year, $176,000 of your pay. Once you make over $176,000, you and your employer no longer have to pay into Social Security. You still have Medicare. Since 2013, they made that part unlimited, so it doesn't matter if you make $13 million a year. You and your employer will still be covering those. But the idea is $176,000. That is a pretty big jump. So that's why sometimes when I see like, hey, Social Security doesn't have enough to move forward, to pay everybody's bills, well, I think about it's like, man, they keep upping that. That's going to really be able to pay, because really the lower income people benefit the most from Social Security. If you only make For example, $25,000 a year, you might be getting $1,000 a month, versus if you make $250,000 a year, you're maybe getting what, $3,000 to $4,000 a month. So it's so much more, but you're not getting the same multiple return. You still have the year that you retire, you can make up to $23,400 if you take Social Security for, let's say, 62, 63, 64, and you're still working. You're only allowed to make $23,400. Now, here's the thing: the year that you reach your full retirement age, you actually can make up to $62,160. So they change that every year. That has also gone up. So this is why I just literally spoke to my uncle. I think it was around Christmas holiday, in between Christmas and New Year's. And we had this conversation. He's like, hey, when I turn 62, I'm taking Social Security. I was like, oh, interesting. Aren't you still working? Yes. I said, okay, well, you're not allowed to take it. I'm sure that you make over $20,000. He points a finger. He's like, yes, I do make over $20,000. Why did you say $20,000? I said, because you can't, every $2 you make above $20,000, you lose $1 of Social Security. He's like, yes, I heard that. Okay, I'm not going to take it anymore. It was funny how decisive, in probably a 45-second period, he said how he was going to take it, and then how he said then he wasn't going to take it. So I use 20,000 because that's such an easy number. It rolls easy off the tongue versus 23,400. You get what I'm saying? So that's the amount that is very important to note there. In regards to Medicare, the premiums now, starting in 2025, are $185. This assumes if you're single, your adjusted gross income is under $106,000. And you're just, if you're married, multiply it by 2, that's $212,000. Now get this, make over $500,000 single, $750,000 if you're married, that is almost $630. Man, if you are, that's a month. If you are married, multiply that by 2. That's $1,200 and almost $60 that you pay for a married couple for health insurance if you are high income. So yes, it does get quite pricey. So there are strategies to be aware of that if you need to control your income, if you need to be able to not show as much income legally, of course, by maybe taking money out of a brokerage account versus an IRA or maybe a Roth or whatever the case may be, there are ways to control it. So yes, it is continuing to rise. Just things that you need to understand from a planning point of view. And that is some of the major changes that we have going on for 2025. Now, what I want to talk about is this year. We only have, I'm just going to say, 11 months. I'm recording the show here in January, and January is important because you have now 11 months of the year of planning. And we now know, unless our president-elect, Donald Trump, decides to, during the inauguration, to say, hey, you know what, I'm going to extend my tax cuts that I imposed in 2017 that took effect in 2018. I'm going to talk about what those were and what they're going to revert back to if, in fact, President Trump does not make any changes. And I'm here to tell you, it's not that pretty. There's a lot of benefits that our current tax code had, whether you love or hate our president. It will take money out of every single person, rich or poor. I'm going to talk about that after this break. We'll be right back after a few words. This is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. We wanted to offer you a free financial assessment for listening to the show so you can help relate it to your specific situation. We offer multiple services such as retirement planning, where you are today, how retirement looks like, talking about Social Security, real estate, planning, even if you own a business, talking about taxes, not just how to save money today, but also throughout retirement. Talk about investments, making sure you're avoiding those high fees, costs, commissions, and also estate planning and insurance, just making sure you're properly protected if, God forbid, something were to happen. And we're offering 1 to 2 meetings, 1 to 2 hours of our time at no cost. Give us a call. We would love to help. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, and fill out the form fill right there on our site. Welcome back, folks. This is Gabriel Shahin, Certified Financial Planner, and your host of More Knowledge, More Wealth here on every weekend. And we're talking about all important topics of personal finance. And I thought, as we start off the year, I was going over some of the changes that we have for 2025. Some of them are basic changes. Some of them are adjusted for inflation changes. No big deal. It happens every single year. But this year, I thought I would talk about, it's a unique year because 2025 is the last major tax planning year you may have. It is huge. And so I was going to talk about the changes. Now, there is a handful of them. I'm probably going to talk about the top, we'll call it 20 of them. And so the idea with this is, are you prepared for these changes? Are you aware of these changes? And are you planning for them? Because that's the big part. That's what is going to make this the busiest year that we have ever at Falcon Wealth Planning. Whether it's our thousands of clients, whether it's the tens of thousands of people we help on an annual basis, the idea is what? To make sure that you're winning and you're not unnecessarily losing money, paying more in taxes, and taking on more risk than you need to. So let's go over some of these ideas, some of these expiring provisions that are happening. The first one I want to talk about is, in fact, that tax rates, highest brackets go from the top marginal bracket from 37% to 39.6. You've probably heard me say historically 40%, 40%, 40%. It's 39.6, and it's been like that for a really, really long time, for over 10 years, outside of this 2018 to 2025. So that is huge, okay? Because now, and it's not just that bracket, the 12% bracket goes to the 15. 22 goes to 25, 24 goes to 28, 32 goes to 33. All the brackets are going up. So yes, we all are paying higher taxes. Let's continue the conversation now for these mega wealthy people, where the estate tax exemption used to be $6 million and they bumped it to 12 per person. So it used to be back in the day, pre-2018, where you could only have $12 million. And that jumped almost overnight to $24 million. Why is that important? We say because it currently, now adjusted to inflation, is almost $14 million. Come 2026, that's going to be cut in half to 7. So if you're married, you used to be able to have up to $28 million before the government takes 40% of it. Anything over that, though, you'll lose 40%. It doesn't matter if you have an illiquid business or real estate. The government's coming after that money. You're going to have to pay them within 18 months of somebody passing. Now, let me be more clear. If you have proper estate planning and you're married, hopefully you have an AB trust provision, whatever the case is, you're able to absorb your spouse's $14 million. That only assumes they die this year. Now, the problem with that is, of course, is there is restrictions that money has. Now, the other $14 million, whether you have it or not, you have that still in your name. And you pay no estate taxes until you die. So you still might be a long while from now. But the idea with all of this, of course, is about estate tax planning. Wouldn't it be nice? We don't want our spouse to die just so we can capture $7 million of estate tax for you and your other spouse. You don't want to have to do that, right? Yeah, I get it. It's $3 million a person. That's a lot of money you can save, but let's be real here. What you could do is do estate planning strategies this year that could take advantage of your spouse's current $14 million before it drops to 7. So there are things that you can be doing. And we heavily recommend that. We've talked about that in previous shows. I'll probably talk about those in future shows to come. Let's continue. You have the standard deductions that will revert back to the previous levels, which is roughly half. It used to be, it is currently 30, might go to 15. So roughly. Exemptions actually come back, which went away during this recent tax change. Why? Because they doubled the standard deduction. So here's the thing. If you an itemized deduction, then you get to write off now miscellaneous itemized fees, which is roughly 2%, anything above 2% of your adjusted gross income, where you can do unreimbursed employee expenses. This is very important for police officers and people who have uniforms, where they're now able to write it off. Tax preparation fees, professional fees, and so on. Phasing out itemized deductions for higher taxpayers will come back. And the cap on the SALT limitation of what you pay the state that you live in whether it's sales tax or state tax, that also gets removed. So that is a positive part, where now if you pay $25,000 to your state in taxes, between that, property tax and sale, car registration and things like that, that is now no longer capped at $10,000. That is now unlimited. So that is actually a positive thing. But here's the thing. For those higher income people, alternative minimum tax comes back. AMT, which, oh, by the way, is limited to a smaller number of taxpayers, but it is a much smaller amount. Also, the amount you can give to charity used to be 50%, or used to be 60% of AGI. Now it's going to go back to 50%. Now that only matters for those who really donate a lot to charity. Also, the child tax credit will be cut in half to $1,000, and the refundable portion of the credit will decline from $1,400 to $1,000. Yet again, lower income getting hurt. Mortgage interest right now is $750,000 is the max you could write off, and it goes to $1 million mortgage. There are certain states where that is not uncommon. Lots of changes here, right? Interesting. Let's continue the conversation. The work opportunity tax credit. This is for employers who pretty much hire certain groups of people, such as veterans or people on federal welfare programs, whatever the case is, empowerment zones. Those will also expire. Credits, employer credits for giving people 12 weeks of paid leave and wages, that credit also expires. The deductible portion of employer-provided meals, which is currently 50% of the meal, will also be eliminated. And the suspension of exclusion for employer reimbursements, such as those that are moving or armed service people, will be lifted. That will no longer be a write-off. I'm telling you, a lot of changes here, right? I'm just pounding through this list. By the way, folks, if you're just joining me, you're listening to Gabriel Shahin, Certified Financial Planner, and your host to More Knowledge and More Wealth here on every weekend. We are talking about all important topics of personal finance. And I'm talking with you some of the changes that are going to be happening after 2025, starting in 2026, and what you should be doing. Let's talk about some business provisions. And one of the biggest ones out there was on the Tax Cuts and Jobs Act was the 20% of qualified business income deduction. What does that mean? Let's just say, depending on your business that you're in, of course, a special service trade or certain types of business income, ordinary REIT income. So like, it's not everything, right? But if you look at it, manufacturing, there was no limit on income or anything like that. Let's just say you had $1 million of profit. And this assumes it's passed through, whether it's a partnership, whether it is an S corporation, whatever the case is, it passes through to you. That $1 million of profits, starting in 2018, which expires this year in 2025, you get 20% write-off on that. What does that mean? They give you a 20% off your $1 million profit, $200,000 write-off. Well, if it's that much money, you get 37% back on that as a tax write-off because you're in the highest tax bracket. Well, guys, we're talking about like $74,000 less taxes you pay. Yeah, so you're happy with these tax cuts that happen, those Tax Cuts and Jobs Act. Very happy. So happy it saved you $74,000 in that exact example. So yes, you want to be careful on some of these on what you can be doing. Some of these were like praying they get extended. Also, bonus depreciation, which used to be $100,000, or excuse me, 100%. Then a few years ago went to 80%, then went to 60% next year. It's going to go to 40, or excuse me, and this year it's going to be 40% and then 20% in 2026. And then after that, no bonus depreciation, which means you have to what? You have to write it off over the depreciation schedule, which could be 5 years, 7 years, or whatnot. That's a big deal. Remember, a lot of people want to go buy 6,000-pound or more trucks or SUVs or whatever to save on taxes. That doesn't happen anymore. I wonder what that does to car sales. Let's continue the conversation. Opportunity zones. That ends come 2027, where you can no longer defer capital gains if gains are reinvested in opportunity zones. This is important because you get to exclude the capital gain income after 10-year holding period. Yeah, that was to reinvest in distressed areas to bring that area up and higher. So yeah, that's a really big deal. And then, of course, you have a few other things here where, like I said earlier, the tax brackets are changing, but also when you look at the base erosion and anti-abuse tax, the BEAT, minimum tax rate will increase to 12.5% from 10%. You also have some of these international items like the GILTI, which is the Global Intangible Low Taxed Income inclusion, which pretty much will move it from deduction of 50% to 37.5%. You have the Foreign Derived Intangible Income, the FDII, which will drop from 37.5% to 21.875% deduction, and so on. There's still a handful of things here, but now we're getting into the weeds. What does this all mean? All this means is planning is always necessary. Having a financial partner that's based on your situation, based on your liquidity, based on what you're comfortable with, based on the taxes that you pay and what you see yourself paying in the future, based on your income increase and decrease and so on, is crucial. I heavily recommend talking with a financial professional. And hey, we service nationwide. We would love to be that partner. You know how to get a hold of us. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website. You can put an inquiry through there. That's falconwealthplanning.com. That's falconwp.com. That was a fast show, folks. I want to thank you for tuning in with us this weekend. You can always reach out to myself or any one of our colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go and visit our Knowledge Center, which redirects you to YouTube. We have over 1 million views, folks. And if you want us to discuss anything on YouTube, on the show, whatever, send your inquiry to radio@falconwp.com. That's radio@falconwp.com. And if you want this episode, any one of our previous episodes, you can go on podcast, Spotify. We have them all there. And folks, we want to thank you for your trust. We want you to feel free and feel comfortable to reach out with any questions that you have. I want you to have a fantastic weekend. Have a great week, and God bless.